Today, we're doing a complete breakdown of International Financial Reporting Standards 16. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying International Financial Reporting Standards, prepping for a Big Four interview, or working in finance, this is everything you need to know. Every lease used to be hidden off the balance sheet. International Financial Reporting Standards 16 changed all that. Now a $50 million operating lease shows up as a $50 million liability. This transparency revolutionizes how investors perceive a company's financial health. You'll grasp how International Financial Reporting Standards 16 reshapes balance sheets and investor decisions. International Financial Reporting Standards 16 emerged to solve a crucial transparency issue in financial reporting. Before its implementation, companies could keep massive lease obligations off their balance sheets. By requiring leases to be capitalized, it has made financial statements more reflective of a company's actual obligations. This shift allows investors to better assess financial risk and compare companies on an even playing field. All entities adhering to International Financial Reporting Standards must comply with International Financial Reporting Standards 16 since January 1, 2019. It is particularly influential for public companies with extensive lease arrangements. The standout requirement is that all leases must appear on the balance sheet, altering the financial landscape significantly. However, exemptions exist for short-term leases and low-value assets, providing some flexibility. This ensures a more accurate depiction of liabilities, fundamental for financial analysis and investment decisions. The lease accounting model fundamentally transforms lease reporting by treating leases like purchases. Companies must record an asset for the right to use the leased item and a liability for future lease payments. This dual recognition affects both the balance sheet and income statement, splitting payments into principal and interest. For interviews, understanding this model is crucial, as it demonstrates how International Financial Reporting Standards 16 enhances financial reporting transparency and comparability. Scope matters because it defines boundaries. A common mistake? Forgetting that leases for minerals or oil exploration aren't covered by International Financial Reporting Standards 16. It's a classic interview trap. Understanding these exclusions is crucial to applying the standard correctly and avoiding costly missteps. Let's dissect these nuances and reveal why knowing them makes you stand out. International Financial Reporting Standards 16 primarily targets leases of property, plant, and equipment. Imagine leasing an aircraft. It's included. The standard ensures transparency by requiring both lessees and lessors to recognize lease contracts on their balance sheets. It's crucial for high-value assets used in operations. However, practical expedients allow short-term and low-value leases to be treated more flexibly, easing an organization's reporting burden without compromising transparency. Certain leases fall outside International Financial Reporting Standards 16 to prevent overlap with other standards. Leases for mineral exploration like oil rigs are excluded due to specific industry rules. Similarly, biological assets have their own standards, keeping International Financial Reporting Standards 16 focused on tangible assets. Service concession arrangements and licensing agreements, such as for films, also stand apart, ensuring clarity in financial reporting. Recognizing these exclusions helps you navigate complex accounting landscapes with precision. A lease isn't just about renting an asset, it's about control and economic benefits. When leasing a fleet of delivery trucks, you decide their routes and schedules, reaping the full benefits of their use. That's what International Financial Reporting Standards 16 recognizes as a lease. It's not merely an exchange of payments, it's having the power over how the asset is used and enjoying the fruits of its operation. This nuanced understanding is what separates proficient financial professionals from the rest. The right of use asset is a cornerstone of International Financial Reporting Standards 16. It's the embodiment of the lessee's control over the leased asset, initially valued at the lease liability's cost. Imagine leasing office space. The right of use asset reflects your control and use over that space. Just like tangible assets, it's amortized over the lease term, mirroring the asset's use. This approach aligns lease accounting closer to traditional asset handling, ensuring accurate portrayal in financial statements. Edge cases in lease accounting can trip up even seasoned professionals. Leasing mineral rights or patents falls outside International Financial Reporting Standard 16 due to industry-specific treatments. Yet an operating lease for a vehicle, even short-term, is included, capturing its business utility. Timberland leases, tied to biological assets, skirt the standard, emphasizing the importance of distinguishing between lease types. Mastering these nuances is crucial for accurate financial reporting and dazzling interviewers with your depth of knowledge. Imagine a company with extensive lease agreements hidden off the balance sheet. International Financial Reporting Standard 16 changes this, requiring leases to be recognized as liabilities and assets. This ensures transparency and comparability. We'll explore how the lease accounting model systematically brings these leases to light, ensuring companies accurately report their financial obligations and assets. The lease accounting model transitions leases onto balance sheets as assets and liabilities, ensuring financial clarity. We'll track Meridian Corporation's journey, having signed a $10 million SaaS contract with Acme Incorporated. This example will guide us through identifying lease components, determining terms, calculating liabilities, recognizing assets, and accounting for payments accurately. For Meridian Corporation, identifying the lease component in its $10 million SaaS contract is crucial. The $8 million software portion is recognized as the lease, standing apart from the $2 million service fee. A common error is not distinguishing these components, leading to inaccuracies in financial reporting. International Financial Reporting Standards mandates separating these elements to accurately reflect lease liabilities and assets. With Meridian Corporation's SaaS contract, the lease term is straightforward, a 3-year non-cancelable period. No optional extensions are deemed reasonably certain, keeping the term at 3 years. Misjudging optional renewals is a common pitfall, affecting liability calculations. International Financial Reporting Standards stresses evaluating all economic incentives, ensuring the lease term reflects probable durations. Calculating Meridian Corporation's lease liability involves the present value of $8 million over the 3-year term. Using a 5% borrowing rate, we derive a $7.2 million liability. Errors often arise from misapplying discount rates or term lengths, distorting liability figures. International Financial Reporting Standards emphasizes using a rate reflecting true borrowing costs, ensuring precise calculations. Meridian Corporation must recognize a right-of-use asset at $7.5 million, comprising the $7.2 million liability and $0.3 million in direct costs. A frequent oversight is omitting direct costs, undervaluing assets. International Financial Reporting Standards requires incorporating all direct expenses and initial payments to reflect true asset value, ensuring comprehensive financial statements. For Meridian Corporation, lease payments systematically reduce the $7.2 million liability, while interest expenses are recorded periodically. A common mistake is not differentiating principal from interest, skewing financial representations. International Financial Reporting Standards mandates this separation, ensuring payments accurately affect both liability and expense accounts, reflecting true financial standing over the lease term. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. International Financial Reporting Standards 16 ensures transparency by requiring specific disclosures, revealing financial obligations in detail. Knowing when and how to apply these can be the difference between a misleading and a clear financial picture. When recognizing a lease, the liability reflects the present value of future lease payments. This typically coincides with asset availability, not the lease start date. Payments include fixed, indexed, or purchase options. The discount rate could be the interest rate implicit in the lease or the lessee's incremental borrowing rate. Low-value asset leases or those under a year may bypass recognition, keeping balance sheets leaner. Subsequent measurement means adjusting lease liabilities if lease payments change, perhaps due to rate shifts or option reassessments. Meanwhile, right-of-use assets undergo depreciation unless a transfer of ownership is likely. Interest expenses on lease liabilities decrease as payments lower principal balances. Recalculating due to term changes affects financial statements significantly, showing real-time financial obligations. On the balance sheet, lease liabilities are split into current and non-current portions, reflecting financial obligations over time. Right-of-use assets align with similar owned assets, ensuring clarity. Finance costs capture interest on liabilities separately from asset depreciation. Detailed notes explain lease nature, timing, and extent, offering insights into these arrangements' financial impact. This transparency aids investors in assessing company commitments. Disclosing total cash outflow for leases shows liquidity impacts. It's essential to reveal lease term assumptions and discount rates used, aiding in verifying present value accuracy. A reconciliation of lease liabilities from start to finish highlights changes in management choices. Details on judgments about lease terms and options offer a glimpse into management's strategic outlook and risk assessments. These disclosures enable thorough analysis of leasing impacts. Consider a CFO managing a $2 million lease liability for a facility coming online in 2024. This influences leverage ratios and financial strategy. Variable payments tied to CPI add $150,000 annually, demanding precise cash flow forecasting. A $500,000 right-of-use asset depreciates over a decade, impacting profits. Reassessing a 5-year extension option might add $1 million to liabilities, highlighting strategic decision-making's role in financial health. These scenarios show International Financial Reporting Standard 16's real-world influence. Meridian Corporation, a global manufacturing company, signs a 5-year operating lease for its Singapore warehouse. Watch how every accounting event plays out. International Financial Reporting Standard 16 requires recognizing a right-of-use asset and lease liability at the lease's commencement. Meridian Corporation records these at the present value of lease payments, $1,200,000. This elevates both assets and liabilities, signaling new obligations and asset control. Paying $20,000 in cash reduces the lease liability and reflects Meridian Corporation's ongoing obligation. International Financial Reporting Standard 16 mandates this payment's reflection on the balance sheet, decreasing liabilities and signifying fulfilled obligations. Under International Financial Reporting Standard 16, the right-of-use asset depreciates over the lease term. Meridian Corporation records $10,000 as depreciation expense, capturing asset consumption. This affects both the income statement and balance sheet, ensuring asset valuation accuracy. Interest on the lease liability, calculated at $5,000, reflects financing costs per International Financial Reporting Standard 16. Meridian Corporation incurs this expense monthly, impacting the income statement and increasing the liability, representing accruing financial costs. Year-end brings key adjustments, ensuring liability accuracy. Meridian Corporation reconciles lease payments, accruing $15,000 for obligations not yet settled. International Financial Reporting Standard 16 emphasizes precise liability reflection, safeguarding balance sheet integrity. Lease modifications require recalibrating the asset and liability. Meridian Corporation adjusts by $50,000, reflecting new terms. International Financial Reporting Standard 16 dictates recognizing modifications immediately, maintaining balance sheet accuracy and financial statement transparency. Termination ends the lease journey, requiring derecognition of the right-of-use asset and liability. Meridian Corporation removes $1,100,000 from both accounts, following International Financial Reporting Standard 16 rules for closure. This final step clears the balance sheet of lease-related entries. Every Big Four and investment bank interview on International Financial Reporting Standard 16 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. The core principle of International Financial Reporting Standard 16 is that lessees must recognize assets and liabilities for most leases. This ensures transparency on the balance sheet by treating leases as financial transactions. A common mistake is thinking only finance leases are recognized. Remember, even operating leases show up as liabilities now, a critical shift from previous standards. International Financial Reporting Standard 16 replaced IAS 17, to improve lease accounting transparency. Under IAS 17, operating leases were off-balance sheet, masking a company's true financial obligations. International Financial Reporting Standard 16 requires capitalization, revealing liabilities like a $50 million lease, impacting financial ratios. Avoid assuming operating leases remain obscure; they are now front and center. This shift enhances accountability and comparability. A company records a right-of-use asset and a lease liability at the lease commencement. The asset equals the liability plus any initial direct costs. A common error is forgetting these costs. Over the lease term, the asset depreciates and the liability amortizes. Always remember to include initial costs in calculations. It ensures accuracy. Variable lease payments depend on an index or rate. Initial measurement excludes these unless they depend on an index/rate. Companies update lease liabilities when such changes occur. A frequent mistake is assuming all variable payments affect initial liability. Understand only those tied to indices/rates do. This precision affects financial projections and compliance. International Financial Reporting Standards 16 and Indian Accounting Standard 116 are broadly aligned, but Indian Accounting Standard has specific carve-outs like lease duration criteria, differing slightly. Both mandate asset and liability recognition, yet Indian adaptations tweak application. A common oversight is assuming full convergence. Always verify regional deviations. They can impact compliance and management strategy. Lease modifications adjust the original lease terms. Under International Financial Reporting Standard 16, they require remeasurement of the lease liability using a revised discount rate. A frequent error is not adjusting the right-of-use asset accordingly. Always reassess both liability and asset for accuracy in financial statements and management reporting. It reflects true financial health. Calculate lease liability using present value of remaining lease payments, discounted at the interest rate implicit in the lease. Often, companies overlook using the incremental borrowing rate if the implicit rate is unavailable. Accurate discounting is crucial as it affects liability valuation and income statement impacts. Master this calculation. It's pivotal for International Financial Reporting Standards 16 compliance. Short-term, less than 12 months, and low-value asset leases are excluded. Many misunderstand this, thinking all leases need capitalization. Recognizing exclusions prevents unnecessary balance sheet inflation. Always distinguish these cases. They provide flexibility in lease management without burdening financial statements, crucial for strategic leasing decisions and resource allocation. A CFO must disclose qualitative and quantitative lease information. This includes maturity analysis, lease expenses, and cash flows from financing activities. A mistake is underestimating disclosure depth, missing qualitative insights. Thorough disclosures enhance transparency and investor confidence. Always aim for clarity. It's crucial for regulatory compliance and strategic financial communication. Candidates often confuse operating and finance leases because both now appear on the balance sheet. Previously, only finance leases did, but International Financial Reporting Standards 16 capitalizes nearly all. This historical context causes slip-ups. Always remember, classification impacts income statement treatment, not balance sheet presence. Understanding this prevents costly interview and compliance errors. International Financial Reporting Standard 16 revolutionizes lease accounting by mandating on-balance sheet recognition, unlike previous standards. It applies to most leases except short-term ones and those involving low-value assets. Lessees must record a right-of-use asset and a lease liability, ensuring a clearer picture of financial obligations. Understanding its objective, scope, and key definitions like lease and right-of-use asset is crucial for mastery. Understanding International Financial Reporting Standards 16's lease accounting model is critical, as it involves precise measurement rules. The lease term includes non-cancelable periods, and initial measurement requires present value calculations. Lease liabilities adjust with interest and payments. Variable lease payments based on indices are included, while periodic reassessment ensures accuracy. Using the right discount rate is vital, and modifications can lead to separate lease accounting. Anticipating key interview questions about International Financial Reporting Standards 16 involves understanding potential traps, such as lease term miscalculations. Unlike U.S. generally accepted accounting principles, International Financial Reporting Standards 16 mandates balance sheet recognition for all leases. Knowing disclosure requirements and handling lease modifications properly is vital. Recognize the nuances in sale and leaseback transactions to ensure compliance. Grasping these essentials can distinguish you in a competitive interview setting. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos. We'll see you in the next one.